Good morning, everyone. Welcome to the webinar. My name is Mike Delpreti. I'm your host. Super happy to have everyone with us today. So good morning, good afternoon, good evening. I know there's folks calling in from all over the world, and I really appreciate it. So thank you for joining. Everybody's busy, and I appreciate everyone investing their time to come in and listen to me for a little bit. So I'm going to start today with, yesterday I sent out an email announcing a new iBuyer report, and I started out with a quote, which I happen to have right here, which I want to read. I believe a deep understanding of the past and present is critical to navigating the future. The individuals, teams, and businesses that will thrive will be those with the best intelligence. Now that's why I'm doing this. That's why I do what I do. That's why I'm having the webinar today, right? My goal here is to give everyone listening a deep understanding of the past and the present, kind of understand exactly where we're at, to better understand the future, better understand what's to come, better understand what's going to happen. So what we're going to do today is two parts. So first part is a market update. That's going to be similar to last time, if you were on the last webinar. Part two is talking about how to invest for the rebound. So I've chatted a lot about being around for the rebound, and things will start to get better soon. The most common question I get asked from people is, okay, what can I do? You know, it's great that you're saying all this, Mike, but what can I do? So I've given that some good thought, and we're gonna talk about that today as well. So if we start with the market update, just to ground everyone, I want to kind of remind you of this, my awesome fancy handmade chart from last time, right? It's understanding the dip, the curve, right? Real estate transactions tracking along, there's a drop, we're at the bottom for a while, and then there's some sort of rebound. So this is kind of what I've been tracking for quite a while. And where we're gonna start this. So with that being said, off to the graphs. All right, so starting with the market update. This is what I talked about last time, right? Kind of this, there's a lot of lead and lag indicators. Ultimately, what I'm most interested in, what I think everybody's most interested in, is number of transactions. What's going to happen to the amount of real estate transactions that are hitting the market, right? But there's quite a lag to get there. If a home transacts, it would be in the process for months, right? 1, 2, 3 months, maybe even more. So there's a bit of a funnel here. What a lot of folks have been talking about lately are these kind of traffic and leads, these leading indicators. And I talked about them last time as well. The short version with that is everything's dipped, but things are starting to come back. And I think that's all that matters for the time being. And the reason I say that is traffic and leads coming through portals are very much lead indicators with a low degree of intent. Right? Somebody browses a website to look for property or fills out a form looking to do a video tour, they may or may not be interested in transacting. What I'm totally focused on, what I've been totally focused on is new listings, because I think that's where intent reaches 100%. If you're gonna put your house for sale on the market, you have 100% intent to sell it, or maybe 99.9. Maybe somebody's just messing around. But I think people are that they list their house because they want to put it on the market. And ultimately, this is real estate, right? It's all about the house. It's all about the real estate. And you can't have real estate without houses on the market. So you can have all the people you want in the world browsing websites, submitting forms, even getting pre-approved for mortgages, going out and doing tours. That's all fine. But at the end of the day, it's the inventory that matters. It's the amount of new listings that are on the market. So that's where I've been focused. It's not the only place I'll be focused. And in the future, I'm going to kind of look at some other indicators as they start to make more sense to take a look at. But for now, we're kind of focused on new listings. And that's what I'm going to spend the next kind of 15 minutes chatting about here. So a couple weeks ago, I came out with this. So if you're on my mailing list, this will not look new, but kind of talking about this, what the dip looks like. And speculating that drop occurs relatively quick in about a week. We're at the bottom for kind of 3 to 4 weeks, and then recovery begins to occur. And if you're on this call, chances are you are here, right? No matter where you are, what market you're in, chances are, not everybody, but chances are you're kind of down here. This is where a lot of markets are kind of at the moment. So this is where we are in this process. And that's why the line is dotted, because it's really unsure what that recovery looks like. All right, so this is all brand new data. Nobody's ever seen this before. Just kind of collected it over the weekend. This data out of King County, Washington, which is the home of Seattle, courtesy of my friends at John L. Scott Realty, shows year over year new listings coming to market. Now remember, Seattle was one of the first hit markets in the U.S. So this is a great leading market to look at to see, okay, what's going on and what's going to happen in this space. Let's see. And then, I think if you look at the data, right, the drop off occurred relatively quick, kind of within 1 or 2 weeks, but we're relatively flat. It's kind of, if you draw an invisible line, which I have here, or a visible line, it's been relatively flat, right? Kind of down 51% week on week. So the last week, new listings were down 50% year on year. It's tempting to look at this and see kind of some signs of recovery. But fundamentally, I'd say Seattle still, and King County is still kind of at the bottom of that curve, right? There hasn't been a material uplift or recovery quite yet. If we look at a couple other counties and locations around Seattle, so Snohomish, Pierce, Portland, down in Oregon, it's generally the same story. This is looking at new listing volumes for the past 3, 4, 6, 7, 8 weeks. Year over year, 2019 and 2020. And you see kind of all the same thing. 2020 new listings coming to market are flat. They're flat in all these markets compared to last year where there was this really great seasonal uptick, right? Things really pumped up a lot in the spring season. We just haven't seen that yet, which, sees these big year-on-year drops. So all 3 of these counties are still down about 50% year on year from where they've been. And they've been like that for the past 6 or 7 weeks. And that it just haven't seen any sign of change. This is out of California. So East Bay, courtesy of my friends at Red Oak Realty. That orange line is what's going on this year and the blue line is last year. So you see the same thing, kind of start of those shelter in place orders. This is, that drop occurs relatively quick, kind of within 1 week. And then we've been, what I would say, just kind of fluffing around the bottom, little ups, little downs. Like look at last year, new listing counts vary quite extensively on a week to week basis. It's not a steady thing. Things come and go, and you can't read too much into 1 week's data point. But when you start stringing them together, that's when you start to see a trend. And, we hit the bottom really fast. Kind of have been messing around at the bottom. Just last week, starting to see an uptick there, which is promising, and this might be the beginning of a recovery in that area. But still, that's down about 50% year on year. Actually, no, closer to kind of 35, 40%. But then if we stay in California and we go to Santa Clara County, different story altogether. Very sharp drop, been at the bottom for 6 weeks now, no real signs of recovery. Santa Clara County down 53% year on year, kind of from last week. So again, kind of continually down at the bottom there. And then New York City, probably one of the hardest hit market in the U.S. New listing volumes down 80, 90%, and have just been sitting at the bottom for 6 weeks now, quite a while. Also, gosh, what was that? I think last week I launched a new tool. If you haven't had a chance to check it out, you should. So US Real Estate Market Tracker, pulling in data from Redfin, it kind of plots out, again, new listing volumes year on year. And what I've done here is I've started the graph basically by the number of days since the decline began, defined as kind of more than a 5% year on year decline. Which is interesting because it benchmarks everything against day 0 because different markets were affected differently. New York, LA, San Francisco were one of the first ones affected, whereas Phoenix and Denver much later much later they saw the effects in terms of new listing declines. So this is really interesting. This is being updated on a weekly basis. I encourage you to check it out. This is data up through the 27th of April, and it shows a couple things, right? This is going by day. It's a 7-day rolling average. So the lines are smoothed out a bit. Again, I just kind of caution you to not read too much into small blips, but it's more about the trend. So this shows me a couple things, right? It shows that some markets like Philly and New York are affected much more. New listing drops 70, 80% than other markets like Dallas, Atlanta, and Seattle, which are down only 20 to 30%. By the way, if you use this tool, you can put it in any city you want. So, go crazy with it. And then you can also see, markets like Phoenix and Denver much earlier in the process. They've only been affected kind of 20, 25 days now to see what's going on. Denver, it looks like there might be a bit of an uptick there. Phoenix, again, it seems like we perhaps have hit the bottom. Same with Dallas, Seattle, and Atlanta. Their bottom, their floor is up here in this not minus 30 to 40 range as opposed to down here. Have really yet to see any certifiable signs of recovery other than it's not getting any worse, and maybe Dallas, maybe Dallas. Speaking of Dallas, Austin's another interesting market. So again, was just looking at the latest data as of 2 days ago, new listing volumes on a weekly basis. Austin was affected differently, clearly through this. New listing volumes kind of generally flat, but compared to last year, still down 20 to 30%. It's what happened this last week that was really interesting. And you can kind of see, oh, wow, we've hit this peak. And it's easy to think like, okay, Austin's recovered or it's on the road to recovery. I'm not sure if it is. Last week, new listing volumes are still down 22% year on year. So it's still down. It's still down, somewhat significantly. And if you kind of go over the past 4 weeks, it was down 47%, then 19, then 38, and now we're at 22. Is that a recovery or is it fluffing around the bottom? I'm not sure. I'm just not sure yet. So I think I just, I'm paying attention to this stuff every single day, and I'm trying to get the information and intelligence out to you as fast as I possibly can. It's very easy to have confirmation bias where you find data to support your narrative. And if the narrative you want to believe is we're starting to recover, it's very easy to find information to support that. You could be excused for looking at this graph and thinking, oh, Austin's on its way to recovery. It may be, but it may also just be these seasonal and weekly fluctuations. So I think it requires a little bit more time before we make that call. And again, Austin and some markets in Texas appear to be the outliers at this point. Whereas again, in California, Seattle, New York, we're still at the bottoms. Here's that real estate market tracker again, looking at 4 markets in Texas. And again, you can kind of see this possible recovery. Like everyone's tightly clustered, after the decline. Austin kind of popped back up a little early. San Antonio, Houston, and Dallas are all generally on the same trajectory there. So again, these little dips right here and here, that's probably some data funny business, looking at this year versus last year. Maybe there was some weird activity in 2019. I'd look at the larger trends as opposed to the individual things, but there is a larger trend here in Texas. So maybe the 2019 data is off to some degree, but you can look at it and say, okay, maybe there is a bit of a bottoming out clearly down here and things are starting up. And actually they're starting up. That's a pretty steep incline. So I'm really eager to watch this over the next couple of weeks to see what happens in those markets. So if we go back to the original graph I showed you, I would update it based on what I said a couple weeks ago. And really the update is down here, this bottom. A couple weeks ago I said 3 to 4 weeks. Right now it looks like it's kind of 6 to 8 weeks. We're still at the bottom. A lot of these markets are still at the bottom and have yet to really see signs of significant recovery. Again, in new listing volumes, you can find good news all over the place. More people are visiting websites, more people are submitting leads. That's true. It is recovering. Those things are recovering. More people are getting pre-approved for mortgages. That's right. But at the end of the day, like all of real estate centers around the actual real estate, the transaction. And if for whatever reason, 50% fewer people are bringing their home to market, that's a significant effect on the market. There's just less houses to buy out there. And that's going to affect everything else. And right now, we just generally appear to be at the bottom of that. So I mentioned it in that update a couple of weeks ago, like the recovery looks like a check mark. It appears like we might see a check mark recovery here. And that's, I think, the best way to illustrate that. Steep decline. I don't know, we're kind of at the bottom. So it may be not an immediate recovery, but it's a funny looking check mark at the bottom for a while and then a very slow recovery. I also want to talk about some international markets. Oh, by the way, if you're enjoying this, like by all means, take some screenshots, throw it out on LinkedIn or Twitter or whatever, like make some noise about it. This is fun, but I'm literally sitting in my home office in front of a computer, drinking a great cup of coffee with no way to interact with anybody. And I miss the interactions. So I'd love to interact with people however possible. So if you're enjoying this, like, yeah, take a screenshot, do something, talk about it. I would love to see that and interact with people outside of this one-way weirdness of me talking to my computer. So let's talk about international markets briefly, just to put this in context, because I'm not totally US focused here. I'm spending a lot of time looking at international as well. China. So this, the epidemic started in China, and you'll have seen this graph if you've followed my stuff before. This is a bit of a simplified one, but this is looking at daily property sales in 30 major cities in China, right? So percent compared to 2019. You see the immediate drop in listing volume. So 100% is last year, and then kind of this slow increase over time, kind of occurring over 3 months, and they've just hit 2019 levels. That's quick. That is quick. And I would not assume that China's recovery is what everyone else's recovery is going to look like for a lot of reasons, but it's a data point. And as you might expect, it kind of looks like a check mark. Second, this very complicated graph from my friends at Zoopla out of the UK shows what that property portal is seeing. So I'm going to walk you through this. What we've been talking about are new listings. New listings is this light blue line. And this is a percentage based. You can see new listings down basically 90%, 80 to 90% in the UK. And that's relative to the very strict and stringent lockdown the UK is undertaken over the past couple months. All right, so then browsing is the purple line. And that's what we talked about as that lead indicator of how many people are on a website looking around. You can see kind of drop 60%, and now it's back, and it's basically 39, 40% lower than before. This is what's happening around the world. Web browsing drops, and then it comes back. In the UK, it just so happens to still be lower than 2019 levels. In many portals here in the US and other markets, it's back up to 100%. So it changes. And then, demand is kind of somebody submitting a lead form. And you can see that it's still down. That makes sense, right? It's easy to browse. It's a little more, not difficult, but it signals a higher degree of intent to submit a form. And then, guess what? It's a lot more intent to bring a market to list. And that's why I'm looking at this, because there's a higher confidence, a higher degree of intent. But this gives you a sense as to generally how the other things flow. Browsing will be affected the least. Demand, the next effect, and then new listings kind of big. All right, and then Italy. I've been tracking Italy closely. So this is out of my a top portal in Italy. This shows new listings drop through 8 weeks of the lockdown, right? So new listings dropped quite significantly, about 60%, stood at the floor for a while, and then we've actually just started to see a bit of a recovery. So that's good. We've hit the floor and things are starting to recover. You see that kind of general shape where 1 to 2 weeks to drop, at the bottom for a while, and then kind of up after that. All right, so that is that's the end of part 1. I'm going to invite my good friend Lane to join us for part 2. Lane, are you there?
I am, Mike.
Awesome. Throw your video on.
Good to be here and interacting with you.
Yeah, I know. This is nice. I can actually talk to another human being. So Lane is a good friend of mine, a neighbor here in Boulder. He's a broker owner of 8Z Real Estate, one of the co-founders of Zavvy. We work together, and we've been chatting about this a lot. So I wanted to bring him in. So A, I didn't have to talk to myself, and B, Lane could kind of give us a point of view from an actual somebody in the space. It's very easy for me to sit here and make all these suggestions, but I don't have a brokerage to run. Lane does. So I think it'll be interesting there. Anything else you want to throw in, Lane, before we get started?
Yeah, I'm ready to roll. Glad to be here.
Awesome. All right, so we are going back for this. So the idea, last time I was here, I talked about, being around for the rebound, right? And step 1 is surviving. It doesn't matter what kind of plans you put in place. If you're not around in 3 months, 6 months, 9 months, as a viable business entity, it doesn't matter. Game over, right? You're not even in the game anymore. And when you look at companies in the real estate space that are undertaking layoffs, that's what they're doing. They're conserving cash so they can be around many months from now. And cash is king. You got to have that runway. But beyond that, what else can you do? And this question I get a lot is, what should you be investing in to rebound faster? Like, there's things you can do now, right? It's halftime. Everybody's off the court. What happens when the ref blows the whistle and everybody runs back in? It's the teams that have been talking about strategy and eating and drinking and refueling and kind of getting ready to go that are going to be the strongest. And the teams, the bigger teams, the teams with more resources are going to be able to do more interesting stuff. So I wanted to provide some practical stuff, and in a lot of my research and exploration and discussions with people and talking to Lane, we kind of came up with these five things that we're gonna run through. So with a grain of salt, and if you feel like listening to us, you totally can. You don't have to if you want, but I think these would be some of our suggestions. So Lane, let's start out with the first one. This everybody's talking about this, but digitization of the transaction. I think my sense of that is a lot has happened. And if things would have taken 3 to 5 years, they've taken 3 to 5 weeks. Whether it's online notary or virtual tours or anything. And I don't want to belabor the point. Everybody's talking about doing virtual, but I guess the point I want to make is consumer demands are changing because of the pandemic, and the faster you can respond to new consumer demands, the better positioned you'll be. If people want virtual tours, if they want online notary, whatever it is, give it to them. I think that's kind of the key investment point. So Lane, what are you guys seeing, and what do you think about this area?
Yeah, I think there's some toothpaste that we're not going to put back in the tube after this, so to speak. And in particular, in the transaction, 2 areas. I went and asked we run a title company. I asked folks at AZ Title, what's going on with the transaction? First is electronic earnest money. Pre-COVID, we had 0% electronic earnest money. We implemented electronic earnest money with the company Earnest. There's some other companies out there. We've already moved to 30% of our earnest money is electronic, and we expect that to go to 70% by the end of Q2. So that's real quick adoption. That's like, DocuSign like adoption.
Yeah.
The other area, Mike, is the actual closing. Pre-COVID, we were about 80% in office, in person, 20% remote. And at that time, remote was mail out with mobile notary. We've already moved to 50-50. Of course, in office is now curbside. And we expect we're planning for post-COVID to remain 50-50, but that 50% remote is going to shift to true RON, remote online notary, starting with cash deals.
So what's enabled you to move quick on all of these initiatives?
I mean, a big factor has been the regulatory environment has changed. And, so that those hurdles are being removed.
Okay, awesome. Well, I think that's, again, I mean, AZ is one of the top brokerages here in Boulder and the Front Range, and being able to move quick to these demands. I mean, are you also, do you feel like it's a new consumer demand? Are you doing it just because you feel like it's a good idea, or are your customers kind of demanding it?
In the case of like earnest money, I think it's one of those things like you don't know how good it is till you have it. And then once the consumer is like, I don't have to go to the bank and do a wire and worry about fraud and all that, it's, it's a no-brainer. So, they're not knocking on the door saying, I want this, but once they have it, they love it.
Okay, awesome.
Yeah.
All right, let's keep rolling. So that's number 1. Number 2 are iBuyer platforms. So I've written about this in the past. I think the iBuyer model has advantages in this post-pandemic world, right? It gives people certainty in a time of uncertainty. You can buy and sell a house contactless. So, you don't have to, you can sell your home without having people tour it. Anyway, there's interesting models. There's interesting advantages to the iBuyer model in this post-pandemic world that can't be duplicated really anywhere else because the iBuyers are an intermediary and they own the house. So they can make the houses empty. So you can sell it without interacting with anybody and then buy one from them. And I think the point around this is if you're a broker or an agent or anybody in the space and you're looking for advantages for yourself, the suggestion would be kind of cozying up with some of the iBuyers or offering their product to your customers, just because that is kind of a new demand. So this screenshot here. So this is from Zavvy. Zavvy's a product that agents and brokers can use to kind of integrate with iBuyers and get the instant offers for their customers. And, full disclosure, I'm on the board of Zavvy, and Lane and I have worked together on that. If you want to do stuff with iBuyers, you can call them directly. You can do something with Zavvy. There's plenty of other options. This isn't a sales pitch, but it's an example. So this is something that we've rolled out to one of the partners at Remax Alliance that basically says, hey, as we're recovering from this, speed is important, convenience and safety are important, certainty is important. Right now, everything's kind of frozen, but as soon as the iBuyers are active again in your market, fill out this form, we're going to start with an offer. We'll just give you an offer. So if you're an agent, I kind of think that's a great way to just stay relevant. All the agents are talking to people being like, well, you can't really do much now. Here's some data. This is something you could do to differentiate it. Like, hey, when the market is back online, I'm going to call you up, and the first thing I'm going to give you is one of these instant offers, and we can talk about that versus bringing it to market and different ways to do that. What did I miss, Lane?
No, you nailed it. I think you captured it all. I mean, the iBuyers are going to be very attractive to sellers whose timeline's already been delayed, who want that safety and the convenience. As a broker owner, I think the iBuyers are also attractive to my agents. I want my agents to rebound quickly. I want them to get a couple deals under their belt, and representing a seller who's selling to an iBuyer could be the way to, get that first win post-COVID.
Yeah. Awesome. Okay. So moving on here, customer communication. So I was active in the market. Still kind of am, looking around. And if you're unable to kind of buy or sell right now, if you're an agent or a brokerage, how can you communicate with customers during this time? You can send out really generic communications, like, with the kind of the stock photos of, people that are seriously sitting down at a kitchen table, looking at an iPad or whatever, or, the for sale sign, and be like, oh, what can you do now? Or you can get really specific. And I think the things that I've liked is data. Replace uncertainty with data. The best emails I get from local agents are just filled with data, looking at what's going on in the market. It's not about trying to pressure somebody into listing their home right now and convincing them like now is a great time to list your home. Really? Is it? Like, I don't know that now is the right time to list your home for everyone. But if you can give people actual market data for your specific market, and kind of like I've done today, show how that's tracking over time and put it in the context of what's happening in the national market, you're going to empower consumers to replace that uncertainty with more certainty about what's going on. And if you're the person to do that, they're going to give you a call when we're in the rebound and things are ready to go. So what are you doing with this stuff, Lane?
Yeah, we've gone to a weekly email packed with data. I think our last email this week had 8 different charts in it. You would have been so happy with it, with it, Mike. Good. At the same time, not everybody is. Some people do like that little warmer touch. So I think both types of touches, the data as well as the human touch, but a lot of communication. And ideally,
you saying I'm cold and I only like data?
I didn't say that, Mike. I didn't say that.
Right.
But not everybody is data driven as you are.
All right. So anyway, like throwing some data, I think that's a really good point, and perhaps not just data.
Yeah, and certainly the data is changing weekly, just as you're showing on all your other charts. A month is an eon in the world.
The next one is investing money if you can. And I've been thinking about this one a lot recently, and it's easy for me to say this, but basically if you're in the market, and whether you're a real estate portal, whether you're an iBuyer, whether you're a broker or an agent, given everything we've talked about, your competition is spending less, right? Everybody's trying to conserve cash. In some instances, your competition might be making layoffs. In other instances, your competition might be pulling back marketing spend, right? If you can afford it, it is an incredible time to spend money and invest because your competition is pulling back. And if you can actually push forward and imagine spending double the amount of money on marketing to get those leads so that when people are ready to transact, you're at the top of the list. Or, all these people unfortunately are getting laid off and furloughed. What if you can go in and grab some top talent so you have a bigger, stronger team on the rebound? It's an incredible opportunity to do that if you can. So Lane, we were chatting before. I mean, what kind of investments are you guys making in this space?
Well, start with, we're investing in talent. We just brought on a new vice president of marketing, super talent. That was already in the works, but we continued with that. We're also investing in technology that we think is going to be more suited to the post-COVID, more remote kind of, after halftime here. So a couple of specific examples. We invested in and launched a social media platform, enterprise-wide content for our agents. We're also in the works of investing in a video platform.
Okay. So you're not just sitting back, not spending money. I mean, you're making targeted investments to be relevant and really thrive in the new world.
We've got a saying, we're pushing on the gas pedal right now.
Yeah.
Absolutely.
Okay. All right. And then the last suggestion here is one about really leveraging agility. So being able to move fast is really important. And given these other four things we talked about and what's happening in the world, I can imagine this scenario where you're at a large publicly listed company with shareholders and investors and a board of directors and management teams, basically all this bureaucracy. How fast do you think they can move, right? If you wanted to spend $100,000 or make a big investment or launch a new, a new product, can you just kind of go into the office today and do it? If you're at a big company like that, or do you have that bureaucracy, which in a time of, relatively a static environment, that's okay. Bureaucracies are not necessarily bad. But in a really rapidly changing dynamic time like now, where things are very fluid, that could be an impediment to moving fast. So, big organizations like that have a lot of stakeholders to get through, they're going to be moving slow. An independent brokerage like 8Z, where Lane's at, able to move fast, right? Private companies that have healthy balance sheets, companies that have leadership willing to take a risk, companies where you don't have to go through laborious approval processes to get things done. That's really the two sides of the spectrum here. So I think the companies that will win or really thrive here are going to be able to leverage their agility. Is there anything you want to throw in on that, Lane? I mean, I kind of assume that's what you're able to do, but any other thoughts you want to throw in?
Yeah, we've been able to be agile, but the concept I would add to agility, or your ability to be agile, is a little bit a function of how tight your team is. So even if you're at a huge organization, tighten up the team, right? In my case, it's not just the real estate organization. It's really helped us that we're kind of a one-stop shop. We have title, mortgage, property management, and insurance, and we have been able to tighten up our team. Tighter your team is, the more quickly you can all move together, especially with all the changes that are, I'm sure, going to still be coming down the pipe for the next 6 months, right? Does that make sense?
No, it absolutely does. It absolutely does. I think that's all good. Just being able to move fast as a cohesive unit, as a team, getting things done is super important in this kind of, new crazy world we're operating in.
And Mike, I'd even bring it down to the individual agent level, because I'm sure there's some individual agents, on the webinar. And think about who your team is: your assistant, your lender, your closer. How tight are you right now with everybody? Tighten it up.
Yeah. No, it's a good point. Tighten it up to move fast. So, all right. Well, there's kind of the 5. Hopefully that's a starting point for the discussion. Want to keep things crisp and on target here. So I hope folks enjoyed that. And I guess just I'm gonna end with this quote that I started out. I mean, all those things, right? It's the individuals, teams, and businesses that will thrive will be those with the best intelligence. And hopefully this gives everybody a sense of what's going on. I hope you enjoyed it. The market's moving very quick. Just this week, 2 iBuyers, Open Door and Offerpad, announced they're going to start buying again. Lane, you mentioned you're putting your foot back on the gas pedal. you know, if anything, we're at the bottom of the curve, but there are signs of things starting to get better. And now it's all about who's going to put their foot on the gas pedal. You know, how hard can you do it, and can you do it before your competition? So over the next couple of weeks, I think it's going to be really interesting to see what happens and who kind of accelerates out of the gate. Yeah, hope everybody enjoyed it. You know, again, stay in touch, take some photos, throw it up on LinkedIn or Twitter or anything like that. You know, follow me, join the mailing list, reach out if you have any other questions or thoughts. I'd love to kind of talk to folks and interact with people. But yeah, that's it for today. Thanks again for joining, everybody. Stay safe, and we'll see you next time.